Hey everybody, Brian Shannon here from alphatrends.net. Today is Friday. It's the 21st of November 2014. Let's look at this market for the week. Once again, if you're trying to short this market and fight the primary trend, you're having a very difficult time as the market once again finished with a gain for the S&P 500 of 1.1% this week. NASDAQ up 2/3%. The Russell lost a little bit of ground, but semiconductors were real strong, and we've just got really a very favorable environment for equities right now. You can argue all you want with it, but if you're going to argue, don't argue with price, because price action is still telling us that we're clearly in an uptrend. We've got the S&P 500 at all-time highs here. We did close with a red candle today. That's because we had gapped up and sold off a little bit, but still closed positive on the day and closed above the prior high that we made on Tuesday. So I still view this market as constructive. You can look at it and say it's up too much or argue with it whatever way you want. But again, we still have and have had since that October low, and where we had turned to bullish when the market made that first higher high above the rising 5-day moving average. We have had that continued pattern of higher highs and higher lows. So this again is where we've made that first higher high above the rising 5-day moving average. We've seen higher lows, and we've seen little bits of consolidation where I was getting more cautious, saying that if we break down below the 5-day moving average and stay trapped below it, perhaps we're going to break support and fall. But we didn't do that. That's the most important thing, that we saw this market continue to hold above that rising 5-day moving average, and no support levels were broken. So we still remain innocent till proven guilty, meaning that the path of least resistance is higher. There's no reason to think that it's not going to continue. But that doesn't mean you just go in and, if you've missed this rally, you buy aggressively right now. You have to manage risk and look at today's action. For today, although the market was positive, we were below the volume weighted average price the entire session. So the sellers were in control today. But one day does not ruin this huge uptrend that we've seen for the last several years here. So next week, I think our first important band of support should be found at about 205.75 to 206. And that's about where we'll see this 5-day moving average rise. Next week, of course, is a holiday shortened week. I won't be in all week. I'll be in Mexico actually getting married. So sorry, ladies, as if there was demand there. The S&P 500, though, as long as we remain above 205.75, 206, we still look at it as innocent until proven guilty. And if we break that, it's not a disaster, because we have this prior support in here as well. And I would think 203.5. 203 to 203.5 is the next big level below that. I would only be bearish if this market got below the 5-day moving average, stayed below it, and started to make lower highs and lower lows. We simply don't have that evidence. We don't have that evidence in the NASDAQ either. The NASDAQ also having a new closing high here today, although again a red candle indicated the sellers were in control. And we can see that you don't need a red candle at the end of the day to know that the sellers were in control. We were below the declining volume weighted average price. People ask me about candles and what they mean, and you look at that red candle. The candle isn't you're not supposed to be able to read into a candle until the session is closed, but we knew all day that the sellers were in control with a declining volume weighted average price and prices below it. So next week we're going to be looking at I think our important band of support, 102.50 to 102.75. That's the most important level for us to hold. If we break below that, it'll start to flatten this 5-day moving average. The 5-day moving average will turn lower, and we would have to be on much greater alert that breaking below and holding below 102.5, that's what would turn it a little bit more possibly from neutral to intermediate term bearish. But we're still intermediate term, long term bullish in these markets. There's just, again, anyone who's tried to short this thing has been losing money. And you can argue with it all you want, and we've heard the argument, only up because of the Fed. Well, the Fed stopped their repurchase program, yet we're not caving in. The Russell 2000 showed a little bit of weakness this week, and we were looking at this one in Alpha Trends saying, it was lower highs and lower lows below a declining 5-day moving average. It turned more neutral and then back. But again, at the end of the week for the Russell 2000, we did show a very small loss here of 0.09%. And let me just go back to that once again. For the year, we're only up 1% in the Russell 2000. But when you look at the daily time frame, it's maybe starting to look constructive. Is this a left shoulder, a head, and a right shoulder being formed here with a neckline up in 118 area? It's possible. As we mentioned a couple weeks ago, from that failed breakdown came the fast move higher, and we'll talk about gold again in a moment with that same scenario. But for now, I think that 105.50 to 106, to 116 is really kind of the key level. But we need to, if we break this week's low, then I would definitely expect a deeper pullback. But even on that daily time frame, we came to the rising 20-day moving average. So there's really not a lot of reason to be looking at this and thinking that it's ready to turn lower. Just because the market is up a lot doesn't mean it's going to turn lower. The semiconductors had been finding some resistance at that 52 to 52 and a quarter level that we've been mentioning. And this week, of course, on Tuesday, we had broken beyond that little band of resistance. And from there, we've seen more higher highs and higher lows above a rising 5-day moving average. You can say, well, we closed lower than the gap, but still, we're, one day doesn't make a trend. We're at new highs for the year for the last, several years in the semiconductors, and it would only concern me if we got really back below about 52 and a quarter. I think anything down to that is probably just more of a think of a yellow light. It's a little bit more cautious, and perhaps below 52 and a quarter, it would turn a little bit more bearish. But there's no signs that the sellers are gaining control, except for maybe a couple hours today, which again doesn't make a trend. Financials were turning more neutral this week, and we were monitoring this support in here. So I think that next week 23.90 to 24. If we break below that, then we have the possibility of lower highs and lower lows below that declining 5-day moving average, which would turn it intermediate term bearish. But again, with such a strong daily chart, it's unlikely that we're going to see much follow through to the downside if it does break lower. So again, the trend is your friend. Now let's talk about some of the other things like gold. Gold had a decent week here. Gold was up, let's see, 0.81%, 2.5% for the month, and close to break even for the year. Now back to gold. I don't trade gold, as I mentioned. I'm actually I don't like it because it gaps every single day, and I don't want to come in and have those gaps. But we are holding above a rising 5-day moving average. Intermediate term, the buyers are in control, but we're at a declining 50-day moving average. And when we look at the weekly chart here, this is what I consider to be a pretty important level. We've talked about this retracement quite a bit, and we've talked about the fact that we just broke a new low. Now, this new low, if we can get back above, if gold can get back above 116, 117 and hold above there, I think you have the possibility that this little drop below support will end up being a bear trap, similar to what we saw the bear trap in the Russell 2000. And from failed moves often come fast moves. So if you are a gold trader, I think you have to be very alert in this area that possibly we're going to trap some shorts under here, and it could get a little bit of a squeeze, perhaps up to these longer term moving averages up near 122. For now, though, if you're in it, I think that these lows are important. You're about 112.5. Apple had a good week once again, as this trend continues to show that, unless we have a pattern of lower highs and lower lows below a declining 5-day moving average, the path of least resistance is higher. It simply means that you can continue to expect upside, but after the market moves from 108 to 116, you have to be careful about making new purchases. The purchases should be made when the stock or the market is breaking a new high from a tight consolidation, not after an extended move. So the proper course of action in there is to continue to just pay attention, manage risk, and be objective. Alibaba, this stock last week, we started getting more cautious on it. It did break support here. It's below the declining 5 5-day moving average. So on the intermediate term, there's no reason to be a buyer. You look at how well this thing is held since it broke beyond that higher high and the volume weighted average price year to date. In here, this is where we first got bullish on Alibaba, and now with it with a declining 5-day moving average, it's neutral at best. It's trying to stabilize in here. I think you're going to need to see Alibaba back above 114. It was support here, turned into resistance, so back above 114 with a flat to advancing 5-day moving average. Then perhaps Alibaba continues, but for now, it's just digesting these gains, and it's actually pretty impressive that it's only pulled back a small amount, and so far has found support at that rising 20-day moving average. A stock that I had mentioned on StockTwits the other day was this FIVE, saying, be aware it was in this area right in here before the breakout. Said keep a close eye on this one for a potential breakout. And here is that where I had mentioned it. It was 40 through 281, and this is the short interest in here. So the short sellers, there's a big short position, 11.5 million shares, and you can see where they added their position with the price right up above. So the stock has broken out beyond that 42.80 level where I'd first mentioned it, and that was right in here. And now we see the stock not significantly higher, but 3 points higher or so. And the proper course of action is to raise your stop to the level comfortable for you. I'm suggesting Alpha Trend subscribers put their stop at 44.60. But again, personalize the trade. Do what's right for you. What would be really dumb is that if you bought it, let's say under 43.5, it would be really dumb to allow this to turn into a loser. Whatever you do, protect your gains. Winners don't take care of themselves. We can look at big short positions. I've been talking bullishly about Taser. Taser's got a great looking longer term chart, and it did make a new annual high here on Thursday. Look at that monthly chart. It's got a big short position in it, and I had originally said, you want to buy this stock over here above 19 bucks a share. At Alpha Trends, we've been having pretty wide stops and got stopped out of it at $19.70 today. So it's the right thing. We've got a good story. We've got a good chart, but when the stock starts breaking down, you have to lock in your gains that are there before they're taken away from you, because we did dip below 19, and you just can't allow a winner like that to turn into a loser. I'm still, I still think there's a good story regarding Taser. The sales and earnings are good. The longer term chart is good, but right now we're below a declining 5-day moving average, and to me, it's better to be on the sidelines in cash, letting it reset up again and present a low risk, high probability entry before putting money to risk again. So I think it's going to need some time to heal. I'll be looking at this one and looking for a re-entry, but now's not the time to own it, in my opinion. Google is one that's had a little bit of trouble recently. We saw that gap, this breakdown in October, and the stock never recovered the way the market did. In fact, it found resistance at this prior level of support. We've got a declining 50-day moving average, and this week we saw it broke some support below a declining 5-day moving average. So I think that Google's going to need to be back above 552 for it to turn more neutral, but it's still not a good trend. Let's talk about Bitcoin for a moment too, because I wanted to follow up on a trade there. I had mentioned this one a couple times recently, one catching a real nice trade right at what was it, 352, I think, right here, or maybe it was right above this level, 353. It ran 100 points. I didn't get the 100 points. I got about 45 of them, I believe. But then I'd mentioned it again last week that getting above 395 was a good place to buy it with a stop at 380. Well, it ran up to 415-ish, so it ran a quick 20 bucks. But then it did break below that 380 level, and the proper thing was to take the loss right there. No one wants to take a loss, but the proper thing is to take the loss and not hold it down another $30, $25, $30 from here. So I think that Bitcoin is going to need some healing to do. By the way, I don't like Bitcoin. I don't even like gold, and Bitcoin is even worse than gold in my opinion. Why is it worth anything, this crazy internet currency? But the fact is, it has some good trades, and when I see the trade, I'll try to point them out. But I don't, I'm relieved when I sell Bitcoin after being involved. This is a chart of oil, by the way, and you can look at oil. It's very similar to the way people are looking at the S&P 500. That is the contrarians. The contrarians are saying, oh shoot, it's down from 107, here it is 75, it's down too much. The fact is, it's still in a downtrend. There's no evidence that the buyers are gaining control. Looking at a weekly chart of oil here, you can see we're in a potential level of support, but we're barely showing those signs of support. So I point out to oil just because the trend truly is your friend. And we see big sell-offs in oil from time to time. We've seen them before. I mean, look at the sell-off we saw back here in 2008 from 145 down to 32 bucks. So it's not down too much. There's no reason to think that you're going to be able to pick the bottom. You want to look and wait for the evidence that the buyers are actually back in control. They're not back in control in a stock like Netflix, which gapped lower, rallied up, and then here what we can look at is the volume weighted average price since the event. So since that gap lower, the average price is up here at 379, meaning that the average participant, since the gap down, owns it at 379. Here we are $20 lower, and Netflix is, in my opinion, looking like it's still got trouble. If you're short there, I think your stop would go probably about 375, which is just above these little lower highs, and we've got that declining 5-day moving average in the area as well. I'll be out, like I said, all next week. I hope you have a good week of trading. My opinion is that we probably need to digest some of these gains. I don't think that it's going to be a big sell-off type situation, but I would say that, as always, manage risk on the individual stock that you're trading. You can't look at the market and say it's at all-time highs, we got to buy Netflix, because Netflix is going down. And you can't look at oil and say oil's down too much. Trade the trends, ignore the noise, and focus on price action. Only price pays.